Hey guys, Brian Baldwin here with Prime Lending. Wanted to talk to you a little bit about student loans. Student loans are something that I see on a good many mortgage applications, and they're handled differently depending on the product that you're trying to use out there. So a lot of times, especially for the younger clients that are out there, they'll have student loans. They'll have just graduated college, or maybe they graduated a couple of years ago and they have their student loans on a deferred payment status. So they're not paying anything currently. Now, way back before the crash, there used to be some times where we didn't have to calculate a payment for that or use it in the ratios. That was always something that kind of was a head scratcher to me because obviously that chicken's gonna come home to roost at some point. You can't defer payments forever. At some point you gotta start paying. The line of thinking on that was that, of course, well, while this client's not paying it now, their income's going to increase later. So when the payment comes in later, they're going to have more income. It's not going to be a problem. Well, we all figured out how that turned out, right? So now what we do is we actually do have to calculate a payment for your student loans on there. So they vary depending on what we have to calculate. Anywhere from 0.5% of the outstanding balance, and that's half of 1% of the outstanding balance on the payment. So for a $10,000 student loan, obviously that's going to be $50 out there. 1% would be $100. So we're going to count $50 towards that outstanding payment if the guidelines say count 0.5%. Most of the guidelines right now require counting a 1% of the outstanding balance for a payment. Again, this is for deferred student loans only out there. Now, if there's a payment on the credit report or you're paying a payment, we're going to count that typically out there. So, but 1% is sort of the worst case outcome in terms of what we have to count. So for a $10,000 student loan, we're counting $100 a month. Now obviously I haven't seen a whole lot of $10,000 student loans out there. Most of them are a lot more than that, but that kind of gives you a simple math on how we calculate that. So we'll stick that payment into the debt to income ratio and calculate the appropriate debt to income ratio with the new mortgage payment, including an estimate for that student loan payment that's out there. Now, a lot of mortgage products also will be able to count what's called an income-based repayment schedule. Now that is where on an income-based repayment schedule, sometimes you can actually have a $0 a month payment, and I can count a $0 a month payment. Just depends on your income and what payment that spits out for you. But we'll need to have that approval letter that you get every year for the income-based repayment schedule. You've got to up that every single year. So we'll need that approval letter that states what the payment is, and then generally we can count that that's out there. But for shorthand calculations, if you just want to be safe and you have a deferred student loan and you're kind of wanting to do this before you talk to a loan officer just to kind of see where you might be, just go ahead and count 1% of your outstanding balance for your payment, include that in your debt ratio, and that's usually what we're going to include on there. So again, that's typically how student loans in a deferred status are calculated and how they're baked into the underwriting criteria. So guys, give me a call if you have any questions, 803-730-0027. Shoot me an email, Brian, that's Brian with a Y, .Baldwin @primelending.com or @team-baldwin.com. Guys, look forward to hearing from you. Thanks. Have a great day.